Hello and welcome to our course. Before driving a car, you must learn how to drive. For exactly the same reason, before you can begin trading, you must learn how to trade and to get to know the market. So what is the market? What gets traded on it? What influences market movements? And how can this knowledge be translated into money? In the next lesson, you'll learn the basics of the fascinating world of trading. The world of global trading is an investment option for traders who are interested in investing their money in order to earn additional capital. In recent years, this market has become accessible to anyone with an interest in it. In order to take part in trading, all you need is an internet connection. However, in order to profit from it, you need knowledge. Knowledge is money. Successful trading is an art form. Successful traders focus on the art of trading. They invest wisely because they understand the laws of trading. They know when to invest, where to invest, and how to protect their investments. One of the most common mistakes made in trading is jumping right into the market without understanding where it's going and without knowing the signs that the market provides. It's kind of like jumping into the water without knowing how to swim first. The odds are stacked against you. Trading these days is done mainly in the short term, in what's known as day trading or aggressive trading, meaning that trades are bought and sold within a short time frame. Day trading is done with highly liquid assets, meaning that the value of the traded asset can change a great deal in a short time. This enables large, quick profits and is therefore more attractive to most traders. Long-term trading is called passive trading and involves trading in time frames of months or years, in the hopes that the value of the invested asset will increase over time. Global trading is done by buying and selling various products. All of these products can be defined under the umbrella terms of assets or financial instruments. Let's list the most popular financial instruments. The first instrument is currency pairs. Currency pairs are currently the most traded assets in the world. They refer to the ratio between the currencies of two different countries. The first currency in the pair, the one on the left, is the base currency, while the one on the right is called the counter currency. In trades involving currency pairs, the trader buys or sells the base currency at the current market price, and then takes a profit or a loss according to the movement of the base currency relative to the counter currency. Commodities. In today's market, not only currency pairs, but also commodities and raw materials are traded, including metals such as gold, silver and iron, and agricultural products such as corn, coffee, rice and wheat. Futures contracts, including crude oil and diesel. A futures contract is an agreement which states that a certain product will be bought or sold at some time in the future at a predetermined price. Oil has a potential for future profits since, as countries develop, the demand for oil grows higher and higher. The price of oil is mainly influenced by varying levels of supply and demand. Crude oil is the main source of energy in the world today and has become more and more popular over the past 50 years among traders of various kinds. Stock indices. Stock indices provide information about the performance of certain groups of stocks. A stock index has a value that changes according to the total performance of the group of stocks represented by it. The index can be, for example, the weighted value of all stocks in the group. Indices can be invested in the same way as single stocks, with returns that are proportional to the change in the index. Supply and demand form the foundation of economics. To understand this principle, we need to understand that as demand for an asset increases, or as its supply decreases, the asset's price will rise, and vice versa. The following is an example that illustrates this principle. Let's say a farmer has 5 regular customers. Each day, his chickens lay 10 eggs. One day, the chickens only laid 5 eggs. Although the same number of clients want to buy eggs, there aren't enough eggs for everyone, making his clients more willing to pay more for each egg, resulting in an increase in the price per egg. In other words, the supply decreased, less eggs, but the demand did not decrease, resulting in an increase in the value of the eggs. This can also go the other way round. Let's say that one day the chickens decided to lay 15 eggs. So now the supply has increased, but the demand remains the same. In order to be able to sell all the eggs, the seller must lower the price of the eggs. In other words, the supply increased, causing a decrease in the value of the eggs. Demand is also subject to change. For example, if one day the chickens lay their usual 10 eggs, but fewer customers come to buy them, the seller may find himself left at the end of the day with unsold eggs, requiring him to lower their price. In other words, the supply remains the same, but the demand decreases, so the value of the eggs also decreases. The following is an example from the global trading market. If a poor economic statistic is announced in Britain, many traders will want to sell the British pound. In other words, the supply of pounds will increase, resulting in a decrease in the currency's value, a decrease in the value of the British pound. Another example: if a crisis in an oil-rich Arab country is announced, the price of oil will increase, due to fears that the supply of oil will decrease as a result of the sensitive developments in the region. Unique terms related to the trading market. Several special terms have been created to describe concepts in the global trading market. The following are the most important terms to know. PIP. This refers to the smallest possible movement in the market. In most cases, it refers to a change in the value of the 4th digit following the period. The value of a PIP is usually calculated by dividing the total amount of the trade by 10,000. For example, let's say we open a trade for $20,000. We'll then divide $20,000 by 10,000, meaning that each PIP is worth $2. Short. This term refers to a sale trade. The term short is used because when you sell, you have less of the sold asset. Going short means entering a sale trade in which you sell an asset. Long. This term refers to a buy trade. Long comes from belong, as in belongs to me. Going long means entering a buy trade in which you buy an asset. Bulls and bears. Another important concept is bulls and bears, or bullish and bearish. The terms bear and bull are thought to derive from the way in which each animal attacks its opponents. The term bulls comes from the fact that bulls ram and fling their victims upward, meaning that the bull indicates an upwards movement in the price. Therefore, a bullish trend is a rising trend. The prices move upwards. A bullish trend indicates a rising trend. A bullish candlestick is a candlestick that indicates a rise in price. The term bears comes from the swiping motion made by the bears, which goes from top to bottom, meaning that the bear indicates a downwards movement in the price. Therefore, a bearish trend indicates a downtrend. A bearish trend indicates a falling trend. A bearish candlestick is a candlestick that indicates a lowering in price. Trend. The market moves in wave-like motions, rising and falling. When the market moves upwards for a certain period, it's called an uptrend. Similarly, when the market moves downwards for a certain period, it's called a downtrend. One of the most important tools in trading is the ability to identify the current trend in the market. We'll go into trends in more detail later in this course. Peaks and troughs. A peak is a candlestick that is surrounded on both sides by two candlesticks that are lower than its highest price. A trough is a candlestick that is surrounded on both sides by two candlesticks that are higher than its lowest price. Support and resistance. The support level is the lowest price level that the market has reached. When a trough is repeated several times, a straight line can be drawn between the troughs. This line represents the support line. The resistance line is the opposite, a line that passes between the peaks reached by the market. Ranging, converging market. Ranging occurs when the market price stays at around the same level with very little change. In this situation, the support and resistance levels are very close to one another. Breakout. A breakout occurs when a ranging market suddenly erupts into a dramatic rise or fall, which breaks through the previous support or resistance level, as can be seen in the diagram. Entering into a trade at the breakout point will usually result in high returns. ABCD. The market is forever moving in waves. What goes up must come down, and what goes down will eventually rise back up. Rises or falls are never absolute. There's always a correction, meaning that at the height of the trend corrects itself and tries to return to its previous value, and then the price continues in the direction of the trend. The correction creates a kind of wave within a wave, as you can see in the diagram. We mark the reversal points on the waves with the letters A, B, C, D. These markings will serve as the basis for the various market analysis that will be performed. It is therefore very important to learn how to recognize them. In this chapter, you've learnt about the global trading market, the assets that get traded, supply and demand, and the factors that influence the market. Several important terms, which will be used later on, have also been explained. Learning without practice is ineffective, which is why I recommend that you practice identifying the terms we've learnt in this lesson on one of the real charts available on your trading platform.